Good afternoon, ladies and gentlemen, and thanks for joining us on today's City Business News Now presentation. As a reminder, this session is being recorded. Zoom participants can submit their questions at any time by clicking Q&A at the bottom of your Zoom control bar. Now, please give a warm welcome to Lisa Blossman, publisher of New Orleans City Business.
Thank you, Jenna, and thank you to everyone for joining us today. Welcome to CB Now, the City Business webinar series. This is our midweek recap where we will learn from experts on the state of their industry. Now I'd like to introduce City Business Editor, Natalie Chandler.
Hi, everybody, and thanks for joining us today. We are talking about multi-state tax considerations and what you need to do and what you need to know about selling products outside the state of Louisiana. We'll discuss sales and income tax nexus, what it is, and how the taxes differ in other states. And joining us today as a panelist is Allison Savello, CPA and tax manager too with Wegman Dezet & Company. Allison, thanks for joining us, and we wanted to hear your thoughts on what we need to know about this topic and why it's important to learn more about it.
It's super important because as we've changed business, I mean, if for no other reason with COVID, and as businesses grow, you increase your footprint, you increase people knowing about you and companies knowing about you. And that's really great for growing business. But what happens is that you also end up creating additional exposure if you're selling into other states. And what most people don't stop to think is that if you're selling into Mississippi or Texas, and I'm just going to pick on our neighbors because they're our neighbors, is that, you know, they may not have the same rules and laws and play by the same games or play the same games as we do here in Louisiana with regard to taxes. And I mean that for both income taxes and sales taxes. So it's super important because there's truly very little worse in life than getting that letter that says you're being audited and you didn't even know that, you know, it was an issue.
Okay, so I understand you have a PowerPoint presentation for us. You can go ahead and do that if you want to pull it up.
Where did it go? There we go. So what I'd call this presentation is the monster in the closet and the monster in the bed, under the bed, selling outside of Louisiana. And I've chosen those words because if it effectively can be quite the monster if you're caught unawares. So what we'll talk about, as was mentioned previously, is the understanding of the concept of nexus, the understanding of the differences for income tax nexus and sales tax nexus, the changes that have occurred affecting nexus, and identifying activities that can trigger nexus. So basically, what is nexus? Nexus is defined by Webster as the relationship or the connection between people and things. As it relates to taxes, what it is the relationship that allows a jurisdiction to tax a transaction. Okay. So the challenge is what creates nexus. You know, what creates nexus for income tax purposes isn't necessarily the same thing that creates nexus for income tax or for sales tax purposes. So you can end up having to file one and not the other. And as I mentioned, what creates nexus here in Louisiana, which we're all here anyway, so we've got nexus, isn't necessarily what's going to create nexus next door. And that's where things become super challenging. So let's start with income tax nexus. Historically, this was always related to having some form of physical presence in a state. And that physical presence was often related to or tied to property, being, you know, an office building or renting an office or inventory or having employees in a state. And employees, when I refer to employees, I'm talking about payrolled employees, and I am including telecommuters in this type of situation. While having a physical presence still creates nexus in a state, things have changed and other situations can create nexus. Oops, sorry, wrong way. What doesn't create nexus is actually just soliciting for income tax purposes only, okay? So it's just the simple solicitation of the sale of tangible personal property. And what I mean by that is you've got a sales team. They are an outside sales team. They are going and knocking on your customers' doors and asking for orders. Those orders have to be approved out of state, so they have to come back to headquarters. Those orders have to be delivered by a common carrier, so UPS, Prime Delivery, let's see, FedEx, the Postal Service, and the company has to be a US company. But what's not covered, and this is where things can get a little challenging and where you can get into trouble, is it doesn't cover services. It doesn't cover leasing of tangible personal property, repairs, collections. If your salespeople collect or collect on those invoices or accept the orders themselves, that's not covered, and that will create nexus. It doesn't collect or cover repossessions, and repossessions can even include changing out inventory, and this whole list of other items. Another big issue that has come or has resurfaced lately is consignment stock, including the stock held by independent contractors. What's happened over time is as we've become less dependent on the sale of tangible property, you know, the pen, the widget, the whatever, and things have become more service oriented and things have become less about going in and dealing with customers, is the concept of economic nexus. And what that means is that even if you're just having regular and recurring transactions in another state, that can be sufficient to create nexus and filing requirements for income tax purposes. Now, some states have also created what's referred to as a factored nexus. And what that says is, okay, so you may have a physical, you may have some form of a little bit of a physical presence, or you may have some economic presence, but you know, truthfully, you're not doing a whole heck of a lot here. So it may not really be worth our effort to go after or to have you file. So, you know, Virginia has they've decided that any kind of positive apportionment factor is enough to create a factor presence. There's the MTC, which is the multi-state tax guidance, multi-state tax commission guidance, which set out kind of a standard that said $50,000 of payroll, $50,000 of property, $500,000 of revenue, or if any one of those factors equals or 25% or more of the total, that's enough for a threshold for filing, and that covers Alabama, Colorado, Ohio, and Tennessee. While California and Maine have similar guidance as to the MTC, but they've got their own rates, with California being 61,000 instead of the 50s, and 66,110 or 6110. Try that again. 610,000, geez and Pete's, of revenue. And Maine made it simple. $25,000, $250,000 of revenue, or rather of property and payroll, which, or $500,000 of sales. And Maine doesn't go into effect until 2022. And truly that just became guidance maybe 2 weeks ago. Connecticut, Michigan, and New York are revenue only states, being with $500,000, $350,000, and $1 million respectively. The biggest thing that has changed over time is the concept of how revenue is sourced. And this is going to be your biggest takeaway from the income side. And most of the time, or historically speaking, revenue has been sourced based upon a cost of performance factor, based on where the work was done is where the revenue is sourced. Well, as things have become more market-based and it's become more service-based, states have started instituting what they refer to as a market-based sourcing. And what that basically is, at a very high level, is they want the revenue to be sourced based upon who receives the benefit of the job or the revenue or the project. So basically what that means is you're sourcing your revenue based upon where the benefits received, where the service is received, where the service is delivered, or where the customer is located. And all of this is decided on a state-by-state basis. Each state will have its own rules. There's also another aspect that gets thrown into the mix on this, and whether or not it's a proportionate or a hierarchical approach. A proportionate means some of the work is done in Louisiana and some of the work is done elsewhere. If that state has a proportionate aspect or theory on their sourcing, they will do a pro rata share. If it's a hierarchical perspective and 51% is done here in Louisiana and 49 is done in their state, and they want and they do hierarchy, then it all gets thrown back to Louisiana. So this is the list of the states that are currently using market-based sourcing. There are 36 of them. And it breaks down which of the states use which of the types of theory on their sourcing. What this can do is they can create quite the challenge in determining who your customer is, where the benefit is truly being received. So at the end of the day, get your personal tax advisor involved early, preferably before year end, because you may have to also get your entity set up with these various states when it comes time to filing. And also you can see by some of the dates, this is an ever-changing list. So we are now at 36 states. The city of New York is included. There are 4 states that do not have income tax. So that brings us up to 40 states, leaving a big whopping 10 that are still on cost of performance. There's also the concept of throw out and throwback rules. Basically what this does is if you end up with a situation where because of the sourcing, you don't have income tax due elsewhere, the state may end up throwing out the denominator or the numerator or clawing back the numerator. So you still end up with almost 100%, if not 100% apportionment going back to your home state. So Louisiana did implement a throwout rule in 2016. So there ends up not being quite as much of what we have historically referred to as nowhere sales or nowhere revenue. So we've got a couple of examples just to give you an idea of how this can go. So with market-based sourcing, you've got ABCD Engineering Company, which is a Louisiana company. Louisiana is a market-based source state with throwout rules. So there may be site visits to wherever the work is done, but all the work is, for most parts, done in Louisiana. It's contracted by a construction company based in Mississippi to build a dam in Mississippi. Mississippi is still one of the few states that's a cost of performance. So even though the benefit of the dam is in Mississippi, because Mississippi is cost of performance, none of that revenue gets allocated to Mississippi. Even though Louisiana is a multi-state, a market-based sourcing state, and the market is not in Louisiana because of the throwout rules, it all comes back to Louisiana. So you basically end up with still having a 100% revenue source to Louisiana. Similarly, if the same basic principles, except this time the contractor is in California. California, of course, is a market-based state. To be quite honest, they're the one that started this. So the total contract is only $500,000. California's threshold, as I so eloquently had difficulty getting it out, their threshold is $610,395 to be exact. So since that $500,000 is below the threshold, you don't have to worry about filing, and that's the only contract in California. You don't have to worry about filing a California tax return. Conversely, that same contract, all other things being equal, except this time around the contract is for $5 million, you will end up being required to file a California return, but your Louisiana apportionment percentage will be decreased. Now for tangible goods, it's similar, but tangible goods, it's much easier to determine where a sale ends simply because you have a delivery. So this time around, we've got the brass company, and they sell decorative items in the shape of brass instruments. So you can tell them, very much a New Orleanian. They sell all over the country, and they have an outside sales team that only asks for orders. The orders are approved back here at headquarters, and it's shipped from the warehouse here in the greater New Orleans area. Based on the above, the brass company does not have an income tax nexus in any other state because they are protected. However, since no other state has the right to tax them, Louisiana is going to throw out the revenue that ships elsewhere, so you're back to 100% apportionment. Sales tax nexus. Now this is a little bit different, and I'm sure you've heard a lot lately about sales tax and filing and requirements for sales tax in other states because of the Wayfair case. But let's start back. Historically speaking, sales tax was also based upon a physical presence, with the physical presence being the same basic items as with income, property, and this includes offices, inventory, printed material held at third-party facilities, oddly enough, is sufficient for sales tax. And if goods are delivered in company-owned vehicles, which will also create income tax nexus. So if you're delivering something in the company van to Mississippi, you are creating income tax as well as sales tax nexus. Also employees, and employees for sales tax nexus are not only sales employees, which are directly W-2 employees, but also independent sales reps that are going out to solicit sales, even if they don't live in the state. So if you've got that rep company, that company that's repping your entity out, and the person lives in Texas, but they're going all over the country, that's enough to create sales tax nexus. So the way it was, like I was saying, is that if you didn't have a physical presence, then you were safe. And this was based on a decision by the Supreme Court called Quill, and that goes back to 1992, which in some ways seems like a very long time ago, and yet others didn't. So Quill didn't have any kind of physical presence anywhere. They were just a direct marketer, predated Amazon, predated the internet. You could call them up and place an order. You got a catalog, you placed an order, you faxed it in, you called it in. The courts decided that was not sufficient at that time to create nexus anywhere other than the state that they operated out of. Reality is, that doesn't necessarily mean that there's not a sales tax responsibility somewhere. Sales tax responsibilities first rely or default to the seller. If the seller doesn't have the responsibility, it could be a contractor if you're in the building industry, or if you are buying things and there's no sales tax on an invoice, you as the end user are ultimately responsible for paying the sales tax. The reality is, most sellers don't, or most buyers don't pay sales tax, which is where audits come through. States realized that, and they started trying to move toward an economic nexus. So the first big win for states was a case in 2005 from Borders. Borders had an online presence. You could buy a book on the Borders online and return it to a Borders bookstore. Barnes & Noble was a similar case. You still see some of their stores around. That the courts decided that that was sufficient to create nexus for the online company. Trend continued with different states saying, okay, if we can't force you to collect and remit sales tax, we're going to force you to collect or to actually report to us who bought in our state. So a number of states actually went through and said, we're going to create a 1099 type reporting requirement for people who sell into our states. And the penalties for not reporting that were so egregious. I mean, $10,000, for instance, I think was the Colorado fine, that many companies just decided, what the heck, I'll just go ahead and register anyway. But with that, what we were moving to is what were referred to as kill quill laws. So despite the fact that quill had been the precedent for almost 20 years, better than 20 years, South Dakota went ahead and implemented a law that said, we're going to require remote sellers to collect and remit sales tax anyway. And this is because South Dakota doesn't have income tax. They were losing money. They were losing their revenue source hand over fist because nobody was collecting sales tax and remitting it. The users in the state weren't bothering to self-assess, so the litigation began, which ended up being the South Dakota v. Wayfair case that everybody heard about, or hopefully everybody heard about, in 2018. Basically saying that physical presence rule of quill was unsound based on today's standards, and that the court stated that substantial nexus is established when a taxpayer avails itself of the substantial privilege of carrying on business in a state. So basically, if you're constantly and recurringly doing business in a state by selling into that state, that's sufficient to create nexus. As of this point, so back in 2018, states started creating similar laws as to the one created by South Dakota. Basically, it's $100,000 of sales into that state in the prior year, 200 transactions or 200 transactions. That was the South Dakota version. Other states have done variations of that, so it is a state-by-state determination. As of this point, Missouri is the only state that has not implemented some type of Wayfair law. Louisiana has one, but you don't have to worry about that. You're here, you should be collecting and remitting sales tax if appropriate. Mississippi is $250,000 of revenue or sales into that state. They don't have a transaction. Texas is $500,000, and that's revenue or gross receipts into that state, even if those transactions are non-taxable. But that's where, but what Wayfair didn't change is if, and where I am still seeing, or we still hear of customers and clients getting into trouble, is that there are things that didn't change. So if you still have that employee that is going out, or rep that's going out and asking for orders, even if all you have is $10,000 into that state, you still have nexus there. So, and then repair. So if you've got people who are acting on your behalf that are repairing your goods or doing installation of your product, then you're creating nexus. Again, the company van will get you into big trouble for both income and sales tax. And providing states into, or providing services into other states that are, where that service is taxable. So in Louisiana, most services are not taxable. Mississippi and Texas, there are a number of services that they have deemed taxable transactions for sales tax purposes that we don't. So you need to stop and consider whether or not those services are taxable there. So what happens after this is, eventually you will get audited. My statement on most presentations I do is audits are going to happen. It's not if you get audited, but when, just like falling off of a bicycle. Audits and taxes can end up in court. And as we all know, you're generally speaking innocent until proven guilty. And that's fine and dandy and works for criminal as well as civil court. But in tax court or in a tax audit, you are basically guilty until you prove yourself innocent. So the other thing that needs to be kept in mind when it comes to audit is that whether or not a transaction is taxed is determined at the end point. So who you are selling to is going to be the determination of whether that transaction is taxable. And and we all hear with regard to audits, or, we are aware of the marketing rule of location, 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 where your auditing rule is documentation, 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 and knowing what sells inside of Louisiana and outside of Louisiana, and who you're selling to, and whether that transaction for sales tax purposes is taxable, or whether your transaction is treated for income tax purposes as a service or tangible property. And for software, that is a bit of a change. Some states consider SaaS and cloud computing tangible property for sales tax, or not tangible property for sales tax, but tangible enough for income tax that they want to grab it. So there's differentials there as well. And at the end of the day, remember that tax equals cash, and the cash can be your customers because of errors. I mean, rarely can you go back to your customer after the fact and say, this should have been taxable, please pay your tax on this invoice. It can be the time that you spend internally based upon your staff, because they're spending time with an income tax or a sales tax audit. It can be the cash that you're spending in interest and penalties, with penalties being non-deductible on your income tax return. And that's it. So if y'all have any questions, I know they were supposed to go to the moderator. That is a very high level of things you should be aware of as you are working through and growing, and you are beginning to sell, outside of the state of Louisiana. As always, contact your tax advisor. Make sure that as you're growing, you're covering yourself with regard to these situations. It's much easier to address them beforehand than afterwards, because once you receive that audit letter, you can't ask for, it's very difficult to ask for forgiveness. I know that some people operate on the precept of ask forgiveness, not permission. This is not one of those situations. And that's all I have.
Okay, Allison, when you say where service is received or delivered, what's the difference between received and delivered for a service?
That's going to depend upon the state ultimately. So if the service is delivered, most states consider that delivery point who you're billing or your contact. So I'm going to pick on Maryland. They have an idea that you deliver it to the person who your contact is for a contract, if you've got an extended contract. So if you're delivering if your contact is located in Maryland, then that's great. If the contract is signed by a person who is working in Maryland, then we're talking Maryland. But if the service is being performed for, I'm going to say, let's say it's something like this, where it's a Zoom meeting for, let's say, counseling sessions. You may be counseling somebody who is sitting in Maryland, but you've contracted with the Veterans Administrator or the VA hospital who is actually located in Virginia, then Maryland would consider that a Virginia revenue. So it gets super spider webby. So definitely with big contracts, talk to your advisors. Make sure that you know who you're dealing with, who your contact is, where the headquarters is for the entity. That billing address is often a default for market-based sourcing items. If it's something huge like you're buying media for like Cox Cable. You know, that's a very focused based on zip code, and you don't have access to that, so your default may go back to Cox Cable. And who are you billing? Which, you know, which part of Cox Cable are you billing? So it's just going to, I hate to say it, depend upon the state.
Okay, and here's another question. If I should be filing in another state, but I'm not, how are they going to catch me?
Audits. And you know, it's funny, 2 years ago, I was in an LCPA. They have a, what they refer to is the SALT conference, which is the state and local tax conference. And one of the moderators for one of the panels was a local, a parish tax auditor. She heads up the tax department, the audit department. And they have, she admitted that they get a lot of their leads for their next audits by their current audit. So when you're being audited, or when anyone is being audited, one of the things the auditors will ask for is your vendor list and your customer list. And they will look and see if you're, and then they will start looking at specific invoices for vendors, as well as whether or not you're charging taxes to your customers. They ask for the vendor list because then they can go and say, okay, here are these vendors that aren't charging the local taxes, or, you know, state or local taxes. And then they send an audit request to that vendor. I mean, it's really kind of mean, but that's just the way it goes. So if somebody is buying from you and you are not charging the correct sales tax on those invoices, then that state may come after, you know, you may get an audit letter from them. Same holds true for income tax, where, you know, you're under income tax audit, they do ask for support for your deductions. And that is a, you know, and then they will match that against companies that are filing in the state. A third way that you can get audited for income tax especially is if you've got remote employees, and then you're doing withholdings and remitting them to other states. And then they see this withholding amount that's coming through, but they don't see an income tax return or a sales tax return. So that's another big way that you can get snagged in an audit and then dragged into the other states.
Gotcha. Well, thank you so much for this valuable information you've given us today. And we are going to put the presentation in this PowerPoint on our website. If anybody wants to see it again, you just go to our homepage. There's an events tab at the top and click on webinars, and you'll see it there. And so we'd like to invite everyone to join us for our next webinar. It will be on August 25th at noon. We'll be discussing what financial statements can tell you about the health of your company. We'll discuss characteristics of the balance sheet, income statement, and statement of cash flows, and also how to use these statements to identify potential problems. Our panelists will be Tommy Lane with Wegman Dezet & Company. Have a great week, everybody. See you August 25th at noon.